Well, hello, active traders, and welcome to our World's Top Traders broadcast tonight. I'm really pleased to be sharing the stage with Price Headley, one of the world's top experts in the trading industry. For those of you not familiar with the brand or World's Top Traders, compared to a lot of the other places that have second tier and so forth educators, I only work with the very best out there, like my colleagues like Steve and Price, and Tony and Peter Bain and Van Tharp and Harry Boxer. So anyway, looking forward to sharing the stage with you tonight, Price.
Thank you, Ken. It's a pleasure to be here. It should be a lot of fun over this next hour.
Yeah. Now Price will be going the first half hour, and then I'll be going the next half hour. As always, all information is for educational use only. We're not making advice about to buy, sell, or hold. By watching this, you agree not to make actual trading decisions. Let me go ahead and turn it over to Price. Just wanted to introduce Price. It's always good from professional speaking background to introduce who you're working with. Price Headley is the founder of BigTrends.com, which provides investors with specific real-time stock and option strategies and investment education to profit from significant market trends. Price has been all over the place, and I've known Price for years from the Money Show Expos. He's also appeared on CNBC, Fox News, and Bloomberg Television. He's been in the Wall Street Journal, Barron's, Forbes, IBD, and USA Today. He's the author of Big Trends in Trading and also speaks regularly to investment audiences nationwide and was inducted into the Traders Hall of Fame in 2007. All of which to say he's one of the world's top experts in the industry, and I only work with the best because I don't know about y'all, but our time is limited here, so let's focus with the world's best people that we can learn from. So really pleased to be here with you, Price, and I will go ahead and turn it over to you.
Well, thank you so much, Ken, for that kind introduction, and it's a pleasure to be with everybody here tonight. And let me go ahead and share my screen. We're going to talk winning trading strategies here and really focus on what's working in the current markets. You know, it's been a very choppy year. In fact, of course, and like Ken mentioned, by the way, everything, of course, that I'm sharing with you tonight is for your information and education only. Nothing should be considered a specific buy or sell recommendation. You know that you are solely responsible for your investment decisions. Do consult with a tax advisor before you make any investments going to impact your unique financial and tax situation. Okay, so with that in mind, let's talk about the market for a second here and look at, basically a very sideways trend, but actually still a very tradable one in the S&P SPY SP 500 tracking vehicle. And it's interesting because, this system in particular is one that, past performance is no guarantee of future results, all that stuff. But this is one of those systems where buying the dips, selling the rips, selling the rallies has really worked well in this market this year. In fact, it's worked really well. This is in TradeStation. This is our Donchian channel system that we kind of customized based on our testing. And you know what, if you went back and looked at this going back, based on, if you took every trade hypothetically, of course, but bottom line is what I like about this is the long trades win, but also the short trades win. It's one of those. It also shows you that you don't have to have a huge winning percentage to do really well in trading. This system's only 43.5% right, but it gives you a performance graph and equity curve before commissions. Factor your commissions in. There's not too many trades in the system over about the last 22 years, about 10 trades a year. So that's not too much. Obviously, we're going to look at things that can be more active than that. But it kind of gives you a flavor for, hey, you could be knocking out some steady, consistent gains in up and down markets. And what I like about it is this is only one signal that it's been on since March. But look at how many times you touch this lower short-term Donchian line in white, and then you've tagged the upper one. You want to buy into the dips on the lower one. You want to sell into the rallies on the upper one. And then, you've got a stop plan. Typically, we put our stops about 2% below our entry. We put our targets on the system up about double that. About 4% up from entry for this particular methodology. You can see you could have then sold out into the rally, you could have bought the dip, sold the rip, as I say, sell into that strength. Now, sometimes it'll keep going, and you kind of go, I wish I hadn't sold. And I'm saying just get out of your bullish position because we're above the long-term 200-day moving average in yellow. This system will not allow you to get short when you're above that. You can see it's been only buying this market for the last the last about 4 years, 3.5 years. You can see that we did get one little set of shorts when the market broke down there in 2011. Remember, that was the worries about U.S. debt, which people should be worried about, and debt all around the world. But bottom line is the market broke down. Then when it bounced back, you sold the bounce. So then you can only go short below that for a little bit. It worked nicely for a few signals, then got stopped out as the trend started to change. But the point is that regardless of which way the long-term trend is. You can still buy these dips in an uptrend. You can sell these bounces in a downtrend. And so that's the first kind of winning strategy that I find is really working well, is that when you go in and look at just the last even 6 months, you can see how many times it's pulled back, bought the dip, sold the rally. And so obviously just in the last couple of days, and again, this is not a recommendation, but you see yesterday we touched into the short-term peak within about 15 cents of the recent resistance here. There's some resistance back at the end of July, just touched within 15 cents of it here yesterday. And look at what happened today. We pulled back not only near the 200-day, but we also pulled back to actually touch a short-term low over the last week and a half or two. And so bottom line is, we count back about now the last roughly about 6 or 7 trading sessions, we've got another short-term low being put in place. So again, when everybody's panicking, that's when you need to be, as Rudyard Kipling said in the poem If, when everybody's losing their heads, if you keep yours, you'll be a man, my son, he said. And basically, you'll be ahead of the rest of the crowd. You'll be far more mature and far more sophisticated to take advantage of that. So that's one of the first things that's working. We would then tie that in with an option strategy. So I don't know how many of you traded options, but the bottom line is that, from my perspective, you need to learn about options, especially when you have sideways markets, because when most people assume there's no opportunity, I just showed you how there's opportunity in the S&P and certainly within individual stocks. We'll talk about that too. But bottom line is that when I tie it to options, I can get that much further bang for my buck. And nothing is perfect. We're going to show you performance and what's happened this year for us, what's worked, and also, hey, some losing trades we had too that basically say that means you've got to make sure you're using proper capital allocation. You cannot load up anytime. I don't care how well you're doing. Even the best and brightest on Wall Street have gone belly up when they went ahead and loaded the boat. So we don't want to do that. But what you notice on this chart, this goes back. This is a time decay curve, or what's known as the theta. The time decay. Theta is just a fancy word for time in the options pricing model. And we're watching just the time portion of the options value. What it does, this goes back to about 120 days, about 4 months from expiration down to the expiration day, 0 days, when there's no more time left in that option. As you know, an option is a time-limited asset. And the idea here is that, you look at the first 30 days and you see that little sliver of the decay is not very much at all. You see you haven't lost hardly any decay in that first 30 days. And it starts to accelerate a little bit from 90 days to 60 days, and a little bit more. You're kind of stepping down here from 60 to 30. But look at where the bulk of this decay, as we bracketed here, most of the decay is happening under 30 days to go before the expiration. Out of that total chart, you can see it's probably in the neighborhood of about 1/3 over the first 3 months, and then in the final month, you got almost 2/3 of the time value getting evaporated out of that total 4-month period. So you think about that, and it's even more extreme, actually, if you were breaking it down further and said, what if we did a dotted line actually with about 7 days to go? We're looking at 7 days left. It's even more extreme. You can see it's something like at least a quarter of that total curve is in the final week over about the last 7 days. Now, what that most people would take away from that is say, well, gee, I should never buy options with a month or less to go, especially not with a week or less to go. That's probably true for at-the-money or out-of-the-money options, especially for people who are new to options trading. That's a pretty good rule of thumb, but I'm actually saying flip that upside down. Consider what happens if you were actually going to sell an option. So talking about winning strategies, and I'll show you how they've been working here for all of our trades in 2015, basically is instead of buying a call, like in this example, say you've got a stock at $47, and you say, okay, the stock's at 47. Most people say, well, if I'm bullish, I want to buy a call. Well, I'm saying, you know what? What if you flip it upside down and say, how about instead of buying a call, what happens if you sell a put? So the idea is the stock's at 47, and you tell me, okay, the stock's at 47. You think it's going higher, or at least you think it's not going to drop. In this case, you think it's not going to drop below 45. You sell a 45 put, but you don't just do that, because if you just sold a 45 put, that means you'd be incurring the obligation to have to buy shares from somebody else at 45 if the stock tanked on down, if we had a market crash, what have you. You need to protect yourself. So at the same time, we would say buy another option, a cheaper option, in this case a 40 put, down further below. So all that's doing is it's capping your worst case risk. In this case, your worst case risk would be 5 points, or on 100 shares, that'd be $500 a contract. But you can also see in this example, if we're doing that, as long as the stock stays above $45, our net proceeds on this, before commissions and all these examples, is $200. You got to make sure you get your commissions down. we can help you find very attractively priced options brokers if you're paying too much for your option trades. But bottom line is that, from this perspective, you're saying, okay, $200 is what we're collecting. We're saying you're risking 500, but actually your net risk is only the difference of $300. That's what your broker would require you to put up as, quote, margin. That is your maximum risk on this particular trade per contract. So you collect 200, you're risking 300. Why would we do a trade where we only get 200 and we're risking 300 in the worst case? Because that's not a 50-50 scenario. There's a relatively minority of cases where you're going to actually incur that max risk. It does happen, but it happens very infrequently historically for us. Again, no guarantee that it couldn't happen multiple times in a row on you if you're not picking well. But bottom line is that in this case, look at how many scenarios you now win at. Stock's at 47. If you buy a call, what has to happen? The stock has to go above 47 for you to make money, because if it doesn't, it stays flat at 47, you're going to lose the time portion of the trade that you put into it. Whether you bought the 45 call, that would be a relatively in-the-money option, or if you bought the more speculative, say, 47.5 or 50 call, that would be at risk of a total wipeout if that stock doesn't move. In this example, you could actually see the stock not only stay flat, but actually go down here to 45 bucks, and you still pocket your full premium at expiration here on this chart. It's only when it starts going under 45 that you start losing some of your profit. In this case, you can see it can go all the way down to 43 before at expiration you hit your break even at $43. Hold on. I could be wrong by $4 and break even at expiration. Yes, before commissions, that's an attractive part of options. Now, I know I don't want to get too deep into this, but what I want to say is that this is a scenario where you start flipping now the odds in your favor to not have to have the stock go up. It can go up, you can win. It can be flat, you can win. It can actually drop, in this case, 5 or so percent, and you still are making money on that trade. So it's just another way to turn it around. These are called credit spreads because you're collecting money in. Your goal is to actually hang on to it and then go from there. Now, past performance doesn't guarantee future results, all that good stuff. But if you look at all the trades we've done in this year, this is our index options timer service where we call out trades. Just showing you, for example, I'm not trying to sell you something. I'm just trying to say, look at both what's worked. Also look at a couple times we got knocked. Okay, so the vast majority of the time it's worked. We're taking in about $10 a trade. We're risking a net of 40. That means we're making about 25% return on our money. And these are almost all on each trade. That's usually our best case. That's typically, in this case, a situation in which we're taking in, a fairly small amount. And if we're just using the $10,000 portfolio, you can see before commissions we're up a few grand over the course of the year. Not bad for about 7 months of work. Now, the point, though, is that look at the last example, not a pretty one. We did get a gap against us. We were betting the market was going to come back down in mid-July. It didn't. It ran straight up and actually gapped up and made it to where we were trying to work our way out of the trade to limit the loss. We couldn't do it. We lost what we put into that trade, the $40 a contract on 25. That's $1,000 we gave back. We were up more, you can see. But the point I want to make is that's 1,000 out of our 10,000. That's about 10% allocation. We're not over committing on any one trade. So I want to emphasize that. I'm not trying to brag. I'm just trying to say, even we can be wrong and say we're going to be wrong sometimes. And if that happens and it gaps against us, don't be overcommitted. We like to say no more than 10% capital allocated into a trade. Okay, so that's the credit spreads is one of my favorite winning strategies in this environment. I want to talk earning strategies too, because I don't want to get too hung up on any one strategy. I want to share with you some other things that are working. And the beauty of earning strategies is most people assume earnings only hits 4 times a year, the main quarterly periods where you see a lot of the action. We've just come out of a July period where we saw a lot of action happening. And yet I'm going to show you an example we just did today of one that actually has earnings, just had earnings tonight, and basically how we position for it coming into tomorrow's trading. Again, these are just for example purposes only, but there's several ways you could trade strategically. If you buy far enough ahead of earnings, you could sell before the event on at least half, or what I always say is that if you're going to hold anything into earnings that's just a directional trade, you should be getting at least your risk capital back off the table. If you have a double in a trade, you can take half off. That's your risk capital back in your pocket. If you got a 50% profit so far in a trade right before earnings hit, take 2/3 of that off, and you're putting your original investment back on your side of the table, and then you can free roll with that other money if you so desire. Now, one of the things we like to do is look at the stock's history of gaps. We want to say, okay, how has that stock moved if there's just a lot of stocks like Netflix might be priced for a 10% move either way, but yet its history of gaps in the last 4 quarters might be 15%. That's not a cheap option, or actually that's not an expensive option if it's priced for 10, but actually it moved 15. We want to find things where they're actually priced relatively cheaply. And if you find them too really cheap, you could actually say, you know what, you could buy a straddle. But we don't actually recommend that most of the time. But I am going to show you how we like to look at the straddle, which is the call and the put together on the same strike. Stocks at $100, the at-the-money straddle would be considered if you looked at the 100 call and the 100 put. That's called a straddle. If you look at a strangle, that's the out-of-the-money option typically on both sides away from 100. Say the 95 put, 5 points below, the 105 call, 5 points above. What I want to share with you is really working well and really been a nice winning strategy for us, especially in this choppy environment, but also especially because earnings reactions are uncertain. The one I'm going to show you, in fact, had a quick flip down followed by a rally after hours here on Monster Beverage that we did today before the close. We'll share with you how we set that trade up. So this time spread, what we call a calendar spread, is actually where you sell relatively expensive or high implied volatility. These are very juiced up options in the very shortest term, weekly options, right in front of the earnings, and then you buy more time further out. So that's what makes it a calendar, is that you're selling one expiration, you're usually buying a relatively cheaper option further out in time as a hedge. The other thing you could do is you could buy after earnings and follow the trend. We can even show you an example of that before we're done if I've got time. So bottom line is that the whole principle of this is that this is just a historical chart of the general conditions of implied volatility in orange versus the historical volatility in blue. That's the actual volatility in blue. The orange line is more of what's expected, what's called implied volatility. And you can see in the classic earnings seasons that are in the red boxes here, notice what's happening. Right around the middle of the earnings season, or sometimes right in front of the start of the earnings season, the second one, about the middle of the earnings season, again on the third one, volatility is relatively high on what people expect the market to do. You can see what it actually does is quite a lot less. And so then you get this collapse of that orange implied volatility line, where by the end of the earnings season, people have kind of gone, oh, well, that wasn't as big as we had expected. The volatilities have all dropped back off substantially. In fact, by the end of the traditional earnings season are usually relatively low. Some of you are familiar with the VIX, the volatility index. This is another measure that it's at pretty low levels historically right now. Now, types of risk. There's a lot of elements of risk you have to manage as a trader, and especially as you get into options trading. You don't just have to know what the individual security is going to do, which if you're a stock owner, that's your main focus usually, is how is that thing going to do over the long haul, and you don't worry about the little squiggles. The shorter term you go, the more important it is to manage these other forms of risk. One is what happens to the whole market. You could own the best stock in the market or calls betting on that stock going up, the market takes a dive, and sometimes those leading stocks get whacked. Liquidity risk, how do you enter and exit at favorable prices on fairly active names? So while there might be thousands of different optional names, we focus on really the top couple hundred, really the top few percent of the optionable universe. Of course, there's lots of political risk with the Fed, with governments that can move global markets overnight with one stroke of a pen, one thing that they might do to surprise investors and traders. And then time risk. Options, as I showed you before, can decline in value as they get close to expiration. So a big part of this is making sure we manage this. Now, event risk, i.e. earnings, is something you've got to also be aware of, and it's those gaps we're looking to manage. And the volatility is something that we want to be aware of. And so before I go and show you how this has performed for us overall, let me show you an example of what I did here. This is actually out of the Options House platform. And this is a situation, I'm just going to reconstruct this from scratch here for you to show you what we were looking at today. What you see happening on Monster Beverage, MNST, and this is not a recommendation because it's already come out, the stock, by the way, actually dropped after hours down to about 135, and look at what's happened now. It's now back up to 151. How many times have you seen that where you thought it was, quote, bad news, you thought you were going to make a bunch of money on put options, and then it flips the other way? Or you thought you had got great news on the stock, thought you're in the calls, you're going to be paying for a really fancy vacation or a really nice toy for yourself, and all of a sudden then you come in the next morning and the stock's down on that great news, like Apple recently had, right? So you say, how is that possible? Well, because of expectations, but also we need to construct strategies where we don't have to care so much about is it going to go up or is it going to go down, but how can we create a wider range of scenarios? Here's where your opportunity lies. And we call out trades through our earnings extravaganza service this way, saying, look at how juicy these implied volatilities are in the short term, August 7th. Here's the August 7th weekly options. Okay, now Monster you see closed today around 145. When we put out a trade on it, it was around 148. It dropped a little bit more. If you were just looking at the end of the day at the 145 call and put, the straddle, as I said, and when you add up the same strike, the 145 call plus the 145 put, look at how expensive those options were with only literally a day to go before they would expire tomorrow at tomorrow's close. You say, hold on. So a 145 call is around $6.50, and so is a 145 put. That means both together are around $13. If you bought that, that means that you'd be betting that by tomorrow's close it will have moved up more than $13, above 158, $13 over 145, or below 132, $13 below. That's a pretty wide range. That'd be a pretty aggressive bet. You might even say, well, that does sound pretty expensive. Maybe I would sell those. Well, if it stays right on 145, you're fine. But if it goes past those levels I was just mentioning, you could get yourself in trouble. But what we like to do is say, you know what? Those were at about 192% volatility. If we can find something that's at least half that or less, you go out not just to the next week's options, but actually to the monthly options here, and those are about 60% volatility. That's actually about under a third as expensive. That's still relatively expensive, but it's cheaper in comparison. If we looked at, for example, the monthly options, you see the 145 call and put out there is about $7 on each side. It's about $14. But hold on, the other one's about $13. This one's only 14 for the 2 weeks further out. That tells you that you could actually sell the short-term ones, buy the longer-term ones. But we don't just do it at the same current price of the stock. I use the market's expectations to tell me, hold on, I just told you before, it's about 13 points in either direction. Now, at the time it was 148, what we did is we said the one that we wanted to do, this is called a calendar spread. And this is in the Options House platform. You can do this on a lot of different platforms. But at the time we're about 148, we said use the 160 options on the upside because that was about 12 points overhead. And let's then add the put side over. So if you were just doing the call calendar, and in this case we were saying you could do about 6 contracts here on each side when we did this, assuming about $1,000 invested into a trade, you can obviously adjust it to what's appropriate for your trading size. Just don't overcommit your capital on any one trade. These spreads are a touch wide. You can see bid 25 cents, offer 90 means you're selling the 160s in the short-term options that expire tomorrow, buying the further out options, just for example purposes only here, but bottom line is saying, see the middle of that's about 60 cents. When we did the trade, we did the total call and put side together for a total of about $1.50. So let's add the put side in too. Because you see, the call side alone, if you're investing, what would invest even if you bought it here at 90 cents? If we analyze that real quick, it would assume you bought it at the ask, which would be a little pricey in my view. But even there, 6 contracts at $90 a contract is $540. It's suggesting, this is theoretical, it's suggesting that if you get the perfection scenario and it rallies up to 160 at tomorrow's close, the short-term options go out worthless at 160 or less. Your 2 weeks out options have their maximum time value right at the money, and it's suggesting you make a lot of money on that trade. Now, sometimes those are a little overstated in my experience, and it suggests that your probability of profit is over in the 80s. These tend to be a little high as well. But what I want to do is I want to raise that theoretical number up even more. So what I do is I say, let me actually bracket the market. Let me add a put calendar in here as well, the same number of contracts. We want to sell that same short-term August 7th weekly option. We want to buy, in this case, a couple weeks out. It's just a little more aggressive kind of play, but we need to adjust our strikes. Remember, it's about 148, and it's implying about 13 points in either direction. So I was saying, okay, go down to about the 135 strike at the time. And now look at what happens as we analyze this. And as I said, we got in for $1.50. You see the middle of this trade is about $1.25. You're going to have to pay a little bit above the middle to get filled on these kind of trades. And if you sell out, you might sell a little bit below the middle. But we analyze this, and these are overstated. It's not 100% probability of profit. That's far overstated because, of course, as you know, there's a gap risk that's not being factored in here. You could lose, in this case, what you put into the trade, which for us, we put in on typically up to $1,000 at $1.50. You could only do 6 contracts, couldn't quite get to 7 for model portfolio examples. And you say, well, okay, if I'm investing in this case, I could lose $900 if the worst case happens. What's the worst case? Well, in this case, you say, well, I'd have to actually let's shrink. Let's zoom in a little bit because you see it's showing theoretically we start to lose below 121 or above 179. You're saying, hold on, the stock's in the 140s. I've got that much breathing room. yeah, I mean, it's something where it gets you excited about the potential for that trade, especially for the fact that, yeah, sure, if it absolutely gets crushed down into the, you can see where most of the loss it shows happening down here in the one teens, or up here in the pushing towards 190 plus is where you're losing most of your money, it says on this example. But obviously, our ideal is to actually see it finish somewhere in this range here. You can, what I like about this compared to, say, the credit spread example I just showed you before is that with a credit spread, it has to stay between the bracketed range. If it goes outside of that, you start losing very quickly with a credit spread. With this example, it could go below 135 and I could still make money, or it could also go above 160 and I could still make money. And so this is the beauty of, we call this a double calendar spread. It's a calendar on both sides, a put and a call calendar, typically fairly equidistant from, about what the market expects. And so the bottom line is it's a little bit more advanced strategy, but once you start to study it and you go, so you're saying I have the potential to make multiples of what my maximum risk is? Yes, you have that potential if you structure the trade correctly. Now, the other thing I was just mentioning is when you look at what the stock did after hours, it finished today about 145. The market sold off. It got whacked too. I'm going to come in and show you that chart as well. But bottom line is that we were looking at the chart saying, you know what, when we go in and look at our kind of classic big trends model, I'll even show you a quick little scan here as we scan for some of these as well. You go in and look and you say, this has been a pretty strong stock. Here it comes. Okay, so pulling that up right now. And basically, when you go in and look at that, you say, okay, if I was trading Monster just from a classic big trends trend profile, you would say, what are all these indicators? Well, again, a lot to cover in a few more minutes to go. But bottom line is that what we'd like to see, believe it or not, is this is the big trends version of Williams percent R. Larry Williams developed this percent range indicator. When it goes overbought, guess what? I actually like to see something go overbought and then keep going up. That tells me that the institutions are wanting a piece of that stock. Now, you see what happened today, right before the earnings, with the market selling off as well. Monster got whacked. The stock, this is, again, if you don't know the stock, it's a maker of energy drinks. Whether you believe in those or not, they've been selling very well. And so bottom line is that this is what we call a retest that's coming out of that overbought mode. But you see how jagged that line is. A lot of times these retest points can be good re-entry points within a trend, and you can see it then snap back off there. However, in case I'm wrong, where could it go? Well, you see that the first kind of support is my lower, my bands I created called acceleration bands here. They're about 139-ish. After hours, the stock went down to about 135.5, and then it's now snapping back right now about 151. That's right back in line with about where this prior support was, 150-160 from a couple days ago. So the principle of all this is that I don't have to sweat which way the market's going to react so much. The one time where I really have a problem is if it makes a monster, literally, move, in this case with Monster Beverage, if it makes such a big move that it gaps way beyond this range. So if it gaps way down or way up, I've made a mistake, right? But if it gaps somewhat in line with the market expectations, or in this case, if it doesn't gap at all, I still can make some money in this trade. If it stays relatively choppy and flat, which looks like kind of about what's going to happen, we finished 145 or 151, up about $5. You see, if this proves right, we still got the potential to make a real nice, healthy profit at tomorrow's expiration, or we might even unwind the trade before the end of the day if it rallies up or down to one of these strike prices. So how does this all end up working? It's got its hits and misses, but if we look at and just kind of quick reminder about how we do this. First, we determine that expected move, looking at the straddle pricing that I showed you, which showed us 13 points on Monster. We set the out-of-the-money call and put in the closest expiration, usually the weekly options when we're selling those legs on the calendar. Then we're buying the same strikes further out on the call and the put, about a month out. In this case, only a couple more weeks out because it was a little more expensive to go out too much further. Then we make sure the volatility is high in the short term and a lot lower, at least half or less on the further out. And then we don't want to have to wait too long. This is an ideal example because we only got 1 day to ride out on the weekly options here. So later is better than early in the week. And then know how to pull the plug. And when you look at that result, again, past performance not guaranteeing future results, started this year around 10K, and you see just in the last month went from the 17K range up into the mid 18s, up about $1,000 again before commissions. Factor your commissions in, make sure you're not paying too much on these, on how you get out. It's always going to be a debit on the way in, and then it's going to be you're going to be looking to either salvage a trade on the way back out if it's not working. You can see we've had a few knocks Akamai, Facebook, didn't go as much as we had hoped they would. They kind of ended up kind of chopping around and ended up getting a little bit more of what we call a sag in the middle of that range than we would have liked. So we just blew them out, moved on. So most of these that didn't work were less volatile in those cases. Walgreens is about the only one in this particular sample that blew up through our 90 strike and ran to like 93, 94, which was too much. So we had to go ahead and the short-term option gained value quicker in that case than our longer-term option we bought. But we just had LinkedIn to help offset some of that and help finish the overall last month on a positive note with LinkedIn moving down from 225, finished down around 200. And so the bottom line is that, that's one where we unwound the put side alone and still have a leftover 250 call out in August in case something good happens with the stock. Not expecting it. That's more like a lottery ticket that's left over at that point. We're not in the game to play lottery tickets. We're in the game to go ahead and book our profits, and then you've got some leftover positions that every once in a while you get a good break on. But bottom line is that this has been a nice strategy for us and one that you can go look to reconstruct. One last quick thing I want to show you when you're starting to look for what has earnings coming out. Let me show you just real quick how we like to do this. When we go into a site in this case, let's go to just open a new window here and show you how I do this. I like to go to a site called Estimize. It's a really nice free overview site, and go to their calendar page. And you can quickly see, okay, if we've got a jobs report tomorrow, right? So that's another element where we're not so worried about the jobs report because we've got that calendar on both sides. And so when you look at this and you say, okay, like Michael Kors had earnings today. Stock's been getting blasted today. It got a huge rally up, kind of short covering rampant, right? You look ahead, though, into, okay, what's coming out. And that's, by the way, where we found Monster down here, you see, was expected at 90 cents. They actually came in at 79 cents. Their revenue was light too, it looks like, and yet the stock, after being down 9 points a day at 145 near the close, is up at 151 after hours. How does that make any sense? The beauty of the double calendar approach, we don't have to worry about that. We'd say, look, it's within that range of expected volatility, and we don't have to worry about wacky market reactions as long as they stay in that expected range. Just be careful about not doing the Netflixes of the world, the Amazons, where they can actually gap up 100 points or more, and they might well go well beyond what looks like an expensive option on the surface. So this is where you start looking ahead into future earnings. You see tomorrow, not a whole lot out there tomorrow, Groupon, but that's a fairly low dollar one. But you look into next week and you start looking for, okay, Procter & Gamble. They've already pre-announced some news there. So pay attention to that. And then looking ahead, I think Cisco is next week on Wednesday after the market close. CSCO, pretty active stock. You see the expectation, 56 cents a share, 12.663 billion expected from Wall Street, and Estimize has their own community ranking. So we can start looking ahead at those kind of names and seeing what's due out. So it's just another way you can go to look ahead and then start to see, is the market expectation cheap, expensive, or about in line, and adjust your strategy accordingly. So with that in mind, I'm going to hand it back over to Ken because I know I want to hear what he has to share about additional winning strategies that he's using in today's markets. And it's always so fun to be with him. He's a great trader. I've seen him, and we've traded, and we've talked about a lot of different strategies over the years. So Ken, I can't wait to hear what you have to share with us here tonight as well.
Hey, well, thanks so much, Price. That's a very brilliant strategy. Price Headley at BigTrends.com is the go-to guy for options. So a lot of my traders ask help for options, and I say, go learn from Price. He knows how to do this professionally. So what I like, one of the takeaways that I always learn from you new things, Price, which I appreciate. One thing that I took away from this was that you can craft or create your own strategy based not only on price but on implied volatility, and kind of develop your own trading strategy that's not just like trading the underlying where we're just looking for breakouts, but you can develop a more intelligent, more step-by-step strategy where you can cover multiple outcomes and control for those and profit from them. So I really like that. I think strategically it's an intelligent approach. So.
Yeah, I mean, really, that's what I love about options is that, you define what you think is the likely outcome, and you can craft, does that strategy work, or has the market already anticipated it? A lot of people make the mistake of thinking, well, this big stock's going to have great earnings. The problem is if everybody knows that, they've already priced for that, then you potentially, that's where you see those sell the news reactions. And so just look for where's the next surprise, or where's maybe the market overestimating good news, or maybe too negative and maybe you see a bounce even on bad news. So I appreciate, again, yes, options are a tremendous vehicle, but certainly one that you don't want to know just enough to be dangerous. You need to educate yourself, and we stand by to help educate people at Big Trends on all kinds of option strategies.
Yeah, and you guys are rock stars at it. So definitely, if you guys want to learn options, and you should add, especially in this market, you should add that trading strategy in addition to trading the underlying. It gives you a little more control over different outcomes and gives you more options in terms of how you structure your trade. So that just came out. But anyway, so thanks so much, Price Headley. Very much appreciate your sharing the stage with me. It's always a pleasure, and you're one of the best guys out there in the industry. So really honored to work with you, and I appreciate it.
Well, my pleasure working with you as well, Ken. It's a lot of fun doing these with you, so I look forward to it always.
All right. Well, thanks, Price. All right, traders. Well, let's take a look at my strategies for today. We're going to look at live charts. As always, all information's for information use only. You may have seen me in Market Watch, Money Show, TheStreet.com, Stocks and Commodities. I was in the July issue. I'll be in the next month's issue in September, and October, November, December too on breakout strategies. Really good to look at current market charts. We're going to look at both swing and day trading charts from today, and we're going to look at how to locate or find the very best entry and exit patterns, how to identify or scan for the strongest charts out there. And you can combine this with options too. If you're looking for what's worth trading, it's good to identify what has extremely strong underlying trend and is therefore more likely to keep running up in your favor, and then also risk management and scaling. So let's go ahead and take a look at it. If we take a look at our charts here, I only have 2 or 3 PowerPoints, and so let's quickly go through those. The very best chart setups are going to be minor gap or window, if you use candlestick to talk, minor gap continuations in trend. And you may have seen me speak on this at the Money Show Expos or my articles in Stocks and Commodities. Multi-day high breakouts and entries following, and this is a rider downer momentum candle or wide range candle days. And so let's take a look at some charts. I'm going to go through some of the 90-day charts, some 15-day charts, and some day trading charts all in the next 25 minutes. So hang on, and let's take a look at what kind of patterns make sense. This one, DBVT, is one of my favorite patterns called an acceleration ramp. And what that looks like is simply a visual pattern in which you have a steady uptrend. This is a 90-day daily candlestick chart. You've got a reasonably strong uptrend continuation. Maybe you missed out on trading that. You have a minor gap up continuation here. Now we're pulling back lately, so we don't want to touch this until it breaks over 45 again. But whenever you see this sequence of a small, steady multi-day or multi-week uptrend that then leads to a 45-degree type angle, kind of like a hockey stick or a check mark, that usually makes for a good trade setup. So that's one of the types of charts I want you to put in your hip pocket in terms of what to look for visually when you're scanning. My other favorite one lately is EROS. So what I'm teaching you right now is just how to scan for what's worth trading. The main thing is look at context of at least a 10% range on a 15-day chart. You know, if you're on a 15-day chart, you want something that has at least a 15% volatility range. On a 90-day chart, you want to have even more volatility. One of the things I want you to look for that highlights whether or not something's worth taking as a trade is always be on the lookout for these visual. Again, I don't use the derivative ATR indicator. I just visually look at how tall the trading ranges in the candles are. You may want to add an ATR indicator if it's helpful, but the main thing is look for wide average true range days, at least 1.5 to twice the whole real body of the previous average 3 to 5 days, and go in 50 cents or $1 above the high on those. And that's a really good way to sort through your charts visually and find out what's worth trading. Now, one chart pattern that I published extensively for many years is what I call a wide range candle at the right side of a bullish cup, or right after a congestion box. I've had competitors since try to borrow that idea, but I guess I shouldn't mind. Anyway, you're looking for a wide range candle larger than the previous candle at the right side, kind of parked at the right side of a bullish cup. And even if you miss the candle, you know, you're scanning and visually you see it on this day, you still go in on a day subsequent, or you miss it on that day. Well, the great news about professional breakout trading, and I've traded millions of dollars worth of stocks and ETFs for the years, and FX and E-minis for that matter, but mostly I'm a stock day and swing trader, is look for wide range candles as a key part of your visual scanning strategy. And when you're looking for the very best charts to trade, I mean, again, learn from my colleague Steve Nissen on obvious patterns like bearish engulfings. That tells you don't want to buy, it's going to drop, right? But also look to integrate that with some of the Western technicals like a wide range candle, and learn how to combine, the things that, folks like Price Headley teaches you about options, myself for breakout continuations, Steve Nissen for candlestick charts, and develop a kind of a hybrid approach that takes the best of what those of us who know how to do this can share with you. And my goal is to keep things as simple and clean as possible for you. So today we had a big sell-off in FTNT, so obviously we don't want to go long yet, but should be on the radar in case it breaks over. I'll put on a long call, say over 50.5 or so. I buy this, the underlying, at say 50.50. I wait for 50-cent increments above nearest whole number highs. So the fact that we got a gap that held, at least for the last couple of weeks, is a good bullish sign, and we did so on increasing volume here, right, as it gapped up. We want to wait, though, until it takes out new highs to buy into it for a continuation play. What you'll find, it's kind of like one of these puzzles that you're solving as a trader, is you're looking for these answer keys where you have these wide signal candles. And if you see an opposing candle, maybe a shooting star, that tells you, okay, well, don't buy anytime unless it breaks above that, and develop a step-by-step approach where you're looking for the very best high velocity, high volatility charts in the first place. The two biggest traders, and I've trained now over tens of thousands of traders, but back in the old days it was thousands of traders worldwide. One of the things that I find the biggest mistake traders make is making stops that are too big, or adding to losing positions, or Price had mentioned this too, like betting the farm, hey, it really looks like it's going up. As my daughter would say, epic fail. You don't want to do that. What you want to do is trade with a little more granularity, or a good Wall Street approach is, you trade light, trade often, you trade a number, you throw a lot of darts at what's moving, and then use money management on the rest to scale into or add to winning trades and get back out of losing trades. For swing trades, when I trade the underlying, it's always no more than a 2-point initial trailing stop, and I will double into a trade every couple of points. So let's say I buy this up at 26.80. I might buy it again at say 28.80 for a secondary trade, then again over 30.80, right? One trade that I took recently, just day before yesterday, was in my Fidelity Sapphire, which I trade MGM stock. Hint, y'all might, again, not a trading recommendation, but you might want to paper trade this if it takes out new highs. You're always looking for good high velocity charts. So, I've been trading MGM for the longest time now, since it was down at $5-6 a share. Every time it breaks above a major moving average line, I see a lot of upside potential in this. Makes a classic shooting star, right? Boom. Then a large green signal candle, and we're off to the races for years in a row. Well, what I care about is the next week or two. What's more likely to hit? So I'm going to scale in over, say, 23.50 and 25.50. The thing that gives you, this is really important. If you take nothing else from me tonight, take this down. You need to have permission of velocity or volatility of the chart, meaning you need to have at least a wide 1.5 to twice average true height wide range candle to get into a trade. Now, I don't have time to cover the average directional index. Price is also an expert in that. The Wilder's ADX. I like to use a 15-day chart on that. And well, okay, I will go ahead and just quickly add it because I can. But what you're looking for in ADX is the red signal line, and I published on this many times, even back with eSignal over a decade ago. When the red signal line comes from below, like Jaws, it breaks over 40. What you do is put a long trigger in 50 cents above, 50 cents or so above the high of that signal day. Odds are you didn't get that day. Maybe you're scanning through your charts and say, oh, that's kind of an interesting chart. Well, you go along 50 cents up to a week or so after that signal day. So ADX breaks over 40, you put it in your long trade, and it usually works out. Like here, ADX broke over 40 again in MGM just a few days ago on the 3rd and again on the 4th, and we're off to the races. Now it's slowing down, so momentum is slowing down as the price goes sideways, but it's still a great long chart. So I'm in it long myself, and I'm going to add to my winning long position up at new highs. So the ADX is a good tool, or a kind of a volatility filter to help give you permission to trade. Combine things like volume. Do you have high volume? At least 1.5 1.2, 1.3 times or better volume, up to 1.5, even twice the volume on a breakout chart, and those make sense to trade. Okay. Another thing to remember is that gaps, and Price mentioned this too, which I like to see mentioned. You should look at your things like earnings quarterly gap history. Does it usually gap up or down, or and if so, by how far? That makes sense. One thing that I like to do as a professional breakout trader, and again, I've done millions of dollars worth of trades. I know how to trade. You mostly always go in trend with a gap if it's less than 10% or so of the price range. So if it's a $30 stock, if it gaps up between 30 and 33, I'm good to go to buy the new high. 50 cents or so above whatever that morning's gap high is, including the pre-market price action. But if it gaps up, say, 6 or 8 points, well, I'll stay clear for a day or two and see what the crowd's going to do. I don't want to go in with the dumb money. I want to go in professional money. So professional money, we always like minor gap continuations. That's my number one money-making play. Minor, defined as less than 10% gaps in trend. And then add to it, with high breakouts if you have a wide range candle. You often see these things in concert with each other. Minor gaps that take out new highs. Nice wide range candle. Now, I'm a skeptic here. We got a couple of bearish upper shadows, not quite a tweezer top, and a bearish engulfing here. So obviously, we don't want to go long here. But if you've ever seen the great movie Princess Bride, inconceivable. Is it inconceivable things would go down in the Magic Kingdom? Well, yeah, because Disney took the mother of all hits today and yesterday. And I told my traders to go short Disney, by the way, on the open today. Boom! Flawless victory. Now, Disney's been my favorite stock for years, but not so much any longer. Look at Disney. Here is a 3-year stock chart of Disney, even bouncing off the moving average line with a hammer. Boom! It's hammer time. Bang! Wide range candle, another Calhoun momentum candle. Boom! But now things are looking bad. If you're a swing trader or position trader, use your institutional 50, 100, and 200 MA lines for decision support. So if you're building a trade all the way up here, the worst you'd let it go against would be, say, 98 or so, 99. As a momentum trader, I called it short today. I always look for a bear cup breakdown. If it makes a bearish cup and goes down, I told my guys to go short. I would scale out at, say, 103.50 or so. That would be my exit for a swing trade. But anyways, when you see a bearish engulfing, that means all's not well in the Magic Kingdom, and it might be a good time to go short this if it loses the major moving average. So when you're looking for these types of charts and others, use a good common sense, very simple price action. This is a hammer actually today, so this might be good for a bounce long over 112, eh? Remember I said that. Again, not a trade recommendation, but remember I said that. One thing you want to do as a trader is trade within your moving averages. So risk reward isn't particularly good for that trade though. Maybe I buy 112.50. It'd only give me, say, to 114.5, 115 trade potential before likely chop and stall out using this as R1 as resistant. Well, actually, this is R1, that's R2. So you don't want to trade that yet. But that's a good volatile instrument or a good example of the type of chart you may want to look at. Minor gap continuations should be the number one chart in your playbook as a professional trader. Another one, AF. I have no idea what that company's chart is. I'm a day trader. They're mystic symbols to me. Astoria Financial Corp. Okay, whatever. As my daughter would say, whatever. I don't care. I just care, can I make some money buying from somebody at, say, 17, selling to someone else at 17.80 or so. I don't generally, as a rule of thumb, like instruments under 20 bucks a share, but I make the exception if I have something that's got a nice 3 or 4 point steady trend continuation pattern. Anyway, this is my wide range candle at the right side of a bullish cup. What else is going on? We have a hammer at a major moving average. That's a favorite candlestick trader's, expert play. If you see a hammer at a, after a downtrend, you'll also often see a recovery. Now, I don't buy pivots. I'm not a pivot trader. I know how to trade pivots to get me out of winning longs, but so for example, here's a bearish. What is this? This would be a shooting star that is part of a 2-candle bearish engulfing. So the trade management strategy would be to sell this puppy under 1580. You wouldn't stay long. If you bought into this on the way up, I'd put a trailing stop at 1580 because you have two signals, a shooting star and a bearish engulfing, right? For more on candlesticks, learn from Steve Nissen. I know enough to be moderately dangerous and profitable, but he's a real expert, and I'm grateful to Steve for what I've learned. Anyway, but I'm a momentum guy, so I don't buy the pivot. I'll use that to put it on my radar, but I'll wait for a breakout. I'll wait for a large candle and go in, say, 50 cents or so above the high, and boom, off to the races, and there's your round trip. Now let's tighten down to a 15-day chart, and then we'll look at day trading charts. I'm going to go over multiple time frames for you. Herbalife, Really nice gap continuation today. Gap from a close of 49 to open of 53.50. Nice four stick 4-point gap, and then it ran another 4 points, right? Very typical ATR based range move. Nice gap continuation. What I like about this, not only the inverse head and shoulders, I don't really care about those. I care about horizontal support resistance. Previous resistance, current resistance, and by no small reason, that's exactly where Wall Street's professional traders gapped it up to this morning. That's why I use a 15-day, 15-minute candlestick chart as my weapon of choice for swing trades, because it does a particularly, not a 12-day, not a 10-day, not a 22-day, 15. For more, you could see dozens of my articles at www.equities.com. I'm one of their featured article contributors. I owe them another one, too. I'm behind on my articles there. Anyway, it's been a few weeks since I published my last one. Anyway, left anchor point, previous resistance, new resistance, now is new support. And that's exactly where they gapped it to. If you look at gap targets, and this is a good, and diverging into gap trading, I'm a professional gap trader. I know how to trade gaps. That's my core trading strategy. You look for gaps to previous support or resistance levels, and you find those over and over again. I just randomly saw that just now. I knew this was a gap chart, but that's a added technical benefit or point, is that they will often gap to previously defined resistance triggers or right above them, depending on the 15-day chart. Here's another one, cores. And again, I didn't have to look hard and long to find these things. Where did it gap to? This is actionable trading data. It gapped to the previous resistance, right? That's not by coincidence. They didn't say, we're going to gap it up today. Gee, Billy Bob, where should we gap it? Should we gap it to 41 or should we gap it to... No, it's the market open... before market, the market on open order flow clears at 9:30 and on, but the pre-market order flow is printing, it's chopping around here. This is a pre-market chart. This is 8 a.m. I always have my charts. I use these signal charts because they're the best. I use my open time at 8 a.m. to 1400 hours because I want to see the trend, if there is one, or the gap pattern or bullish cup pattern, and I will go long above a bullish cup in market and print the trade green. Anyway, what you're looking for is a recovery to previous resistance, and you find these patterns. I'm a professional pattern trader. That's what I do. You look for and you see these patterns, and that tells you put together a buy stop order, say 42.60, 42.80, and let it go up. And if you're swing trading, these are my favorite jumpstart type of charts because the institutional guys are getting in, right? Now, there's a lot of morons out there who say, sell the gap up or buy the gap down. Yeah, let me know how that works out there for you, Sparky. Usually what happens is when they gap it down, it goes down. When they gap it up, it goes up. When they gap it up, it goes up. For proof, I mean, look at the S&P. You know, when it gaps up, it runs. When it gaps down, it goes down. When it gaps up, it goes up. Look at the broad market cross. I used to be a corporate statistician and quality engineer for the Ford Motor Company. Great company. Anyway, I digress. So I'm an expert at data points, and one of the things you're looking at is repeatable, consistent data patterns in your chart. So here is the left anchor point on a 15-day chart. That sure enough was S1 here and here, right? That's not by coincidence. If I had only used a 10-day chart, I wouldn't have actionable trade data. If I used a 22-day chart, I'd get confused because there'd be all these other support and resistance areas. So the 15-day is the sweet spot, and this is Suncor. Another good example of a minor gap that ran on up a nice point and a quarter from the gap, bullish or bearish engulfing, pulled it back down, 1, 2, 3 pattern, and it kept going on up. Okay. Another one, USG, minor gap continuation. What you want to look for is, let's say you see something that's in a trend. Don't be afraid. I will tell you this, and it took me many years, by the way. I spent my career, my first few years of my trading so-called career, blowing out trading accounts and making up every stupid mistake known to man with real money trades. And after you blow up a couple of trading accounts and then you stop telling your girlfriend or now the wife at the time how much you lost. If you've ever, and I do this when I speak at Money Show Expos, and I always get these knowing laughs and nervous chuckles from the audience, but I say, if you ever conceal your trading losses from a spouse or significant other, or your pet chihuahua or your goldfish or whatever, you might be doing it wrong. So go back to paper trading, back to square one, or small size, small lot, small contract trading. and learn the right way. Learn from the people out there who are actually really subject matter experts. Like Price is a great guy. I have absolutely no hesitation recommending the world to go to learn options. And he's an expert technical guy. He's a great trader in his own right. He knows how he knows how to help you guys teach. Harry Boxer's great. Peter Bain, Steve Nissen, Tony Turner, Van Tharp. Kind of like that's a short list and that's it. Learn from the genuine experts, not all the second tier wannabes out there. Learn from people who actually have their trading chops and expertise and know how to teach you. Anyway, so back to it. Minor gap continuation run. Oftentimes, back in my early days, I'd always try and trade pivots, and I'd have a department store mentality. Why should I pay $29 for it when someone else got it for $27 yesterday? Wrong-headed thinking. Napoleon Hill would say, correct thinking. I believe it was Nap Hill who is one of his principles in Think and Grow Rich is there's a lesser-known book called Think and Grow Rich with Peace of Mind. True story. And Clem Stone's also the implementer, a great guy to learn from too. But anyway, correct thinking is important. Or maybe it was Edward Stemming. Anyway, some smart person said correct thinking. Correct thinking is buy new highs, sell to them at the first sign of trouble. Not try and buy on the cheap and hope it bounces, because that usually doesn't work out. What you want is these minor gaps that continue on up to new highs. Xilinx had been hot. BXLT, not doing much lately. What have you done for me lately? You got a hammer here and a bullish lower shadow there. Like wake me if it gets over 39.50, eh? But we do have a minor gap continuation because of this increase in trend here that led to new high buyers. And so that's another type of chart to look at. When you put things in context, continuation plays are almost always going to be the best bet, not reversals or gappers, or opposite things. For example, Apollo, University of Phoenix, minor gap, sold off like a son of a gun. Minor gap. All the bad traders who said, well, it used to be $28 or even $30 a share. Let's buy at 20 because that's a bargain. Well, how's it look to you now? Right down at 13. Gaps continue in trend. Will I buy this on a bounce? Yeah, but only if it gets back over 50 MA. A play the day for the upcoming month or two ahead. And remember I said this too, and I'll come back and say, see, I told you so, is if our inverse ETFs like the VIX-tied ones like UVXY, which was up today on the market weakness. That's my favorite one. I'm playing long, UVXY. And our other inverse ETFs like QID, it's a little early for them, but they're starting to show strength because the market sells off. And all the bear or inverse ETFs are the types of instruments that you want to start looking at for potential long entries because they go up when the market goes down. My favorite of all of them is UVXY. I also trade VXX and XIV, but UVXY is the best both intraday as well as swing trading volatility. And you can see when the market dropped, this thing ran up. It goes exactly opposite, let's say pull up a spider's chart, right? When the S&P dropped and kept running on up, the UVXY went long. So buying the correct strategy is to look for recoveries of each of these moving average lines. So not a trade recommendation, but at least that's what I'm trading, is whenever we get back above each of these moving averages, if and when we do, I start scaling in. And what I like about this is you can see multi-year high vol. This is a 3-year chart, kind of hard to see because it used to be way up here, cost adjusted, way at 10K a share. Volume has gone up significantly as all the professional traders are putting their money where their mouths are and betting long in the short term. Basically, professional traders are going short the market by loading up the boat. I don't know if loading up the boat's the right phrase to use, but going extremely long the last month or so here, and they'll happily, and I'll happily sell it to people out there at 90 or 120, 150. So last time the market dropped this, put that on the radar for the upcoming week or two ahead. And last thing I wanted to mention was some of the examples. This is performance of my actual calls this morning in my live trading open room. Not a pitch for the room, unless you want to say how to day trade stocks, and I'm the best guy to learn that from. And I am, because look at the performance. This is how my actual calls did today. The ones that I highlighted in green were winning trades. The main thing from this segment is what should you be looking at for trades in the first place? The answer is not more on cheap penny stocks. It's instruments that have some kind of velocity or volatility that actually have some juice to them. So MBLY, I called it short at 56.7 and again at 57.30. We went long when it flipped back up over 57.8 for quick scalp. Those are the type of charts that a day trader likes, or FOXA. Now some of them, this is one, for example, I called it short at 28.80 here for my guys today. And by guys, I mean ladies and gentlemen. We had a bear cut breakdown. I didn't go short pre-market and even on the open, but slightly after that, right before 10 o'clock, I called the short there, and we covered out into the pivot. And those are the type of charts you want to look at from an intraday trading standpoint. At least this was how we did in the live room today. And these are the types of charts that may serve you well if you do intraday trading. Like MDLZ, I called it short today this morning at 47.8 and again 47.50. And again, I put these alerts in place before the market opens, and then once they hit, then I walk everybody through step by step. And obviously you find support at the previous day's price action range, right? So this is a rare example of a gap fill that went down. A gap that didn't fill much was today's Green Mountain Coffee. It went on decaf special because it gapped down from 76 to 54, the mother of all gaps. Boom. Is that a 10% gap? No, that's a much bigger than 10% gap. I'm not going to do the math. It's late. I'm tired. Haven't had coffee in a while. But anyway, the day of a huge Mongo gap in a large cap instrument, oftentimes what will happen is you get professional traders will just scalp it back and forth in 1,000 or 5,000 share blocks trying to grind out their trades, and it doesn't go much of anywhere for us home day traders. So what you do is keep this on the radar for the next upcoming several days to see if there's some price action moves. So those are the type of charts you want to look at in your trading. To wrap up, my initial point was, let's see, there's a shooting star today, right? Shooting star, and sure enough, it's sold down. See, it moved up, shooting star, and promptly sold down 2 points. This is more likely to what? Gap down tomorrow and get more sellers. If it bounces, well, hey, wake me if it gets over 56.5, 57. Maybe I'll take a shot and trade up to 60. But as a good trader, one of the things I want y'all to be keenly focused on is trading, high velocity charts that actually have some run to them. Things like this, where it's not wacky up and down and too extreme, and it's not slowly putting you to sleep, but it's got a good strong momentum, a good head building, a good what I call acceleration ramp, where you've got a pattern like this. And even if you stay clear of shooting star, you get in a new highs, and it's still up 10 points from that, or now 7 points. But those are the type of charts you really want. At least that's what I like to focus on in my swing trades. And I gave you a taste of some of the day trading charts as well. So let me go ahead and wrap. Wanted to again say thanks so much to Price for being here. For both of what we taught you, look at things like entry patterns to trade, stops, profit targets, and exit signals. You might want to map out your process with a top-down flow chart to visualize where your key bottlenecks and constraints as well as success areas are, and then developing a personal learning and a trading plan, or what I call a profit plan, and then take action with it from there. So anyway, I wanted to wrap up for tonight, and thanks so much, Price, for being here and for staying around. You didn't have to stay around, but thanks for being here. I see you did. And thanks to all of our traders out there. We had a really big turnout today. We had 468 for today's session. So to all of you, thanks so much. Encourage you to learn more from Price Headley at bigtrends.com and myself at Trade Mastery or daytradinguniversity.com as well. So thanks so much, everybody, for being here. I appreciate it. And thanks, Price, for making time.